cost of capital, capital structure, and the financial leverage. We must understand that any business that starts requires funds to operate. And these funds that are used have a cost attached to it called cost of capital. This is what makes what we call the capital structure. Types of capital used include common stock, preferred stock, debt, and retained earnings. Managers of a business will usually want to resort to using retained earnings because this is the only part that does not incur any costs. Now, each of these carry a cost, as mentioned, so it will therefore be important for us to understand the cost attached to the capital for the following reasons. Both maximization, we may need to know which of the available capital structures are there that will help us maximize well, for capital budgeting decisions, and finally for other cost decisions. As much as possible, you would want to minimize your costs. So we have the following costs that we're going to look at. There's one which we call the cost of debt. So loans have what we call interest attached to them. Bonds too are examples of debt that we're talking about. Debentures all have interest attached. Now, interest is a cost of borrowing. For debt specifically, because of the income statement, there is a tax that is already deducted. So accountants have now come to an agreement to say we need to shield this cost from incurring double expenses to what is called the debt, the tax shield. Now, this tax shield, 1 minus the tax percentage, usually lowers the overall cost of debt and gives a benefit to a company to avoid them being what? Taxed twice. So the cost of debt, when taken into account, will lower the debt percentage. For instance, if we have a cost of debt of 10% and the tax rate is 40%, the cost of debt after tax becomes KD 1 minus tax. So KD 1 minus 0.4, so meaning the cost of debt instead of being at 10% will be at 6%. This has been reduced, and the major advantage is that you're going to pay less. Another source of capital is preferred stock. Now, preference shares are a hybrid kind of equity because the investors in here usually put their funds just to earn an interest, a fixed amount of dividend. So you may have, for instance, a 10% preference shares that have a price of maybe $10. Well, let's look at this. You have preferred stock, which pays a dividend of what? 11.70 and sells for $100. So the cost of equity using this formula, our dividend paid is 11.70 over the price of the share, which is $100 times 100. So our cost in this case becomes 11.7%. So this is how we calculate the cost of preferred stock. So I'm pointing you to what is called WACC, which is a weighted average cost of capital. But before we go there, you need to understand each of these constituencies. These are key and vital. So when we go to equity, equity has two ways of calculating it. There's what we call the CAPM model, which takes into account risk-free rate. In Zambia or anywhere else, the treasury bills are the most risk-free assets that one can borrow. Then we have the risk premium, which is the difference between the expected market return minus the risk-free rate times the beta. Then we also have what we call the dividend growth model, which is KE D0 over P0 plus growth, where we know that D1 is what? D0, 1 plus growth. So we're going to look at an example here. Suppose a stock of risk-free rate has a risk-free rate of 8%. The expected market return is 14%. And we have our beta as 0.7. Find the cost of this stock. So since we're using the CAPM model, our risk-free rate is 8%. Our market return is 14%, minus a risk-free rate of 8% times the beta, which is 0.7. So when you calculate this, you're going to get 12.2%. This is the cost of equity or common stock. Alternatively, this could be calculated as follows. A stock has a dividend D1, 1.40, and the growth rate 6.6, and is selling for 25.54. You're being asked to calculate using Gordon's model the cost of equity. So we know that D1 over price of stock now as growth rate is the Gordon's model, the dividend model. So our D1 is 1.43. Please note that if you are given this as D0, you need to calculate D1 as D0, 1 plus growth. These are emphasized over and over. So here we have 1.43 over 25.54 plus 6.6. You're still getting 12.2%. Then the retained earnings. These ones also belong to the owners, or the shareholders, and are supposed to be paid out of what? The dividends, as dividends. So the cost to the shareholders is opportunity cost of foregoing what? The dividends, and they represent the cost of retained earnings. So the cost of retained earnings is also the same as the cost of what? Of equity. This is usually combined. I repeat, we know that the retained earnings, which are the profits, they belong to the owners of the business, who are the shareholders. After all, these ones are supposed to be paid out as dividends to the shareholders. So because they're part of equity that are supposed to be paid as dividends, accountants have resorted to say the cost of equity is as good as the cost of retained earnings. So this amount is lumped into what? The retained earnings or the cost of equity. Now, how do we calculate WACC? So a company is given a capital structure which has different streams of capital with associated costs. So when we calculate the average of that with the respective weights, we call that the weighted average cost of capital, WACC. Weight is denoted by W, K is a cost. So we could use the cost of the weight structure with the proportions, and we can use the market value format. So now we have a company that has been given, usually given debt, long-term debt 3 million, preferred stock 1 million, common stock 6 million. When you add this, you get 10 million. So 3 over 10 is 30%, 1 over 10 is 10%, 6 over 10 is 60%. So these are our weights. More to this, we are told that tax is 40%. So we're asked to calculate what? The weight wacc. So now, from the other capital structure, we had our debt as what? 10%. We'll multiply this one by 6% because of the tax shield. When you subtract 0.4 from there, we remain 6%. And we already calculated the cost of preferred stock. We're given here, which is 12%. Then the cost of common stock has been calculated as 12.2%. When you compute all this, you're going to find final answer as 10.32%. You can see here, this is important, where you're calculating our cost wacc. Any questions so far? Any questions so far?
Maybe we go through this example again on what I didn't understand on the percentages, the ones which are on your right.
So we're given the costs as follows. We have 3 capitals. We have what? Common stock, we have debt. We had preferred stock and common stock. So 3, 1, 6. So we have preferred stock and we had common stock. So the amounts that we have 3 million, 1 million, and 6 million. So this is 10. So the weight of debt is simply 3 out of 10, which is 0.3. The weight of preferred stock is 1 out of 10, which is 0.1. The weight of common stock is 6 out of 10. Common stock is equity, which is what? 0.6. Then we're given costs. The examiner has already given us costs. Cost of debt is what? 10%. The cost of preferred stock is 4%. This is given. And the cost of common stock is 4.2%. Additionally, they are given tax of what? 40%. So tax will only affect the debt because of the tax shield. So instead of paying 10%, 1 minus T. So we're going to have to pay 6%. Do you understand where this 6% is coming from? You understand where the 6% is coming from?
We subtract from 1?
Yes. Cost of debt is what? KD 1 minus tax. I think I explained the tax shield very well. So, is there anyone lost on how we're getting the 6%? So here, this is 6%. Then here, the preferred stock we're given 12%. Then here, the common stock we're given 12.2%. Then weight
Excuse me.
times cost. There's a question?
Yes. Please just go through again on how to find the tax sheet.
I didn't get the question.
I think please go through again on how to find the tax sheet.
The tax shield, we are just multiplying the cost times 1 minus tax. So the cost of debt is 10%. And the tax we've been given is 40%. So it's 1 minus 0.4. So 10% times 0.6 is what? 6%. So this 0.3 times 6% is 1.8%. Okay, multiply this is 1.2%. Then what are you getting there?
Uh, 7.32%.
7.32%. Okay. Then what becomes our final answer?
Ten point 10.32.
10.32%. Okay. So any questions this far? So I want to take you through now an exam type question so we can analyze it. Unless there's anyone first behind, I don't want to move. I'm going to send you a question paper which was recently written. So we get a work question from there. So by the time you're done, I need you to be able to bring any question that you feel you don't understand, be able to tackle it. But before you do that, you need to understand all these concepts that I'm discussing. Okay, please let's apply what I've just talked about now. Okay, so we have a question on WACC. If this one has book balances, I would want to start with one that has no book balances. So in this question, we're given that road pave Zambia has a beta of 0.85. The market premium is 8%, and the Bank of Zambia treasury bills are currently at 5%. The company's most recent dividend is 1.60, and the dividend is expected to grow at 6% rate indefinitely. If the stock sells for 37 per share, what is your best estimate of the company's cost of equity using both the Gordon model and the CAPM model? Okay, so what are we given from the data? Please don't embarrass me. You're on record. What do we have here?
We've been given the beta 0.85. Risk premium 8%. Current yield of 5%.
5%. The treasury bill. The treasury bill, what type of it? It's a risk-free. And this is a risk premium. The risk premium is what? Expected
8%.
market return on a risk-free rate is called the risk premium. Which is given by what? 8%.
Yes.
What else are we given? A treasury bill is an example of a risk-free rate, which is what?
5%.
So using the CAPM model, how do we calculate the cost of equity? Risk-free plus what? Beta, the expected market risk minus risk-free rate. Remember this, right?
Yes, yes.
So our risk-free rate is what? 5%. The beta is what? 0.85% or 0.85. All this is a premium. So our premium is what? 8%. What becomes our cost of equity?
Is it 73%?
3%. 5% plus what? 0.85.
0. Yes.
0.85 times 8, what do you get?
0.85 times 0.08. It's giving me 0.068.
6.8.
I've converted 8% into decimal.
No, just do it direct.
Okay. 0.85 times 8. 6.8.
And what do we get? 11.8.
11.8.
8%. Anyone behind on this? Okay. Now we go to Gordon's model. Who remembers Gordon's model? What are we given under Gordon's model? What is this? What is this? Is it D0 or D1?
It's
D0, said most recent. Okay. Then our growth rate is what?
6%.
6%. And what else are we given? Our P0. What is our P0?
37 quarter per share.
7 quarter per share. Okay. What else are we given? I need the rest to participate. You know how I love participative classes. I can't have one person participate because I was teaching all of you this. But Cheba, can you take over?
Okay.
Yes. What are we given? We want to use Gordon's model. So our P0 is what? 87. Okay. So what is the formula for Gordon's model? The cost of equity. But just from looking at it, what is the formula? Anyone else? Gordon's model. I showed you Gordon's model. Just recently.
One.
PE is equal to what? D1 over what?
Over PO plus G.
PO plus G. Okay. So our D1 can be calculated as what? D0, 1 plus growth, right? Where you're going to have what? 1.6, 1.06 over 7 plus our growth of 0.06. Quickly calculate.
Thank you.
What have you found? 11, what do you find? 10.58. Did anyone find that?
Yes, that's the answer I found also.
So what can you conclude? Which one is a better model that is giving us what could your conclusion be at that point? Okay, so we can go to another question. So that is how you calculate using Gordon's model. So this is equity. And the solution on the group. Is it clear? Is anyone lost behind?
It is clear, but I'm trying to look at the previous calculations. For me, they're not adding up. 5% plus the calculation 5% plus 6.8.
5.8. The previous ones.
Yes, this same ones. 5, because when you use the calculator, it's giving me 1.18. No. Yes.
Where?
5% plus 0.85 times 8%.
You use board mass, you can't add.
Yes.
What is 0.85 times 8?
It's 8.6.
Are you sure? 0.85.
Sorry, 6.8.
Yes. 6.8 plus that's the 8 here. That's what you meant? Okay, I've seen where you meant just an 8 there. Okay, are we getting somewhere?
Yes.
Okay, then we can go to another question from the exam. Kasuba Solar Company sells electricity in Katanga region of DRC. Because of increased mining activities, the company has prospered and expects to continue to do well in the near term. The company will pay 0.75 per share dividend to investors 1 year from now. Investors believe that Kasuba will increase dividend by 15% before settling down in the long term, 3%. Investors expect 8% return on Kasuba Solar common shares. What is the current selling price of the stock? I want somebody to tell me what we're discussing here and what we're given. I always emphasized, don't embarrass me. We talked about this in the previous class. What topic is this? Stock valuation. So what are we given? The question. Let's identify what we're given.
Dividend
Be specific.
was 0.75.
Is that D0 or D1?
This one, this should be D1 because they're saying a year from now.
Okay. And this is D1. We all agree? What else are we given?
The growth G, which is 15%.
Percent. Okay. So 0, 1, 2, 3, 4. So 1, 2, 3, 4. So here from now 0.75. That is D1. Then the growth rate is what? So our growth rate is what? 15%.
Yes.
This is for how many years?
5 years.
So this is 4, 5, 6, 7. So it is for the what? Subsequent 5 years. Next 5 years. So next 1, 2, 3, 4, 5 up to this, isn't it?
Yes.
So how do we find dividend for year 2? I gave you a shortcut. Just multiply by 1.15. Because 1 plus R is what? 15%. So to be growing at 15%. So let's multiply 1.15, 1.15, 1.15, 1.15. Because 15% is for the next subsequent years. Then thereafter, it drops to 3%. So 3% from this one goes down here, 3%. So we're going to multiply the next from year 6 to year 7. We're going to multiply by 1.03. Since it's dropping to 3%. Here it's 1.15. So what is 0.75 times 1.15? What are we getting here?
0.8625.
8625. Please, you've seen where I'm getting the questions from. This is postgraduate. Right? I'm emphasizing these questions are from postgraduate. The last time I had an issue because most of the questions were similar to what was coming. These questions you can see from the papers, these are postgraduate questions. So I don't want any issues. This here, we are randomly selecting questions. So we're looking at question number 3. Starts from the past paper. So should it come exactly as it is? It's just coincidental. Some of the questions come from there. Then here next, what are we having? So this answer times 1.15, what are you getting?
It's 0.99.
0.99.
18.
8. And here?
One point zero nine.
1.1.
1.
4.
1.099.
Confirm somebody audible.
1.14065.
140. And next?
1.3117.
Next?
1.5085.
Is it not supposed to be multiplied by 1.03?
The next one, after this one,
Oh, okay.
is 1.5.
0.85. 1. Yeah.
Then now times 1.03, what are you getting?
1.5537.
Okay, so are we okay with this is called the DDM, the dividend model, to project the future values. Are we okay so far?
Yes.
So now we need to discount each of these ones to present here. Our discount rate is what? The rate of return is 8%, right? Our KD is 8%, isn't it? So here,
Yes.
the KD is the present value. So calculate the present value. You can use a table, or you can just be using 1 over R on each of them to the power the respective n. So for the first year, just do 1 over 1.08 to the power 1. Second one to the power 2. Third one to the power 3. Okay, what are you getting here?
Okay. 0.6944.
Okay. Next. So if you want, you can use a table, the present value table. This future value, you put present value under 6%, and start going under 8%, and start going down. This is supposed to be 0.926. I don't know what the others are finding. 0.926, then 857, then 794, then 735. Confirm, because if you get that wrong, it affects this. So what are you getting here? %, 1. So 1 over 1.08. What are you getting?
Zero 0.9259.
Yes. Next. The power 2, the power 3, the power 4, the power up to the power 6.
To the power 2, it's 0.85.
0.85.
73.
Pardon?
73.
73. Next. Please just be quick. Others can start from behind here. We need to move quick. I only have 5 minutes with you. Then the other one is
The power 3, 0.79.
794.
Yes.
Next.
0.7350.
0.735.
0.6805.
0.68.
06.
So 681. Then here.
0.6302.
Okay. Then multiply this by that, this by that, this by that, this by that, this by that. Let's multiply each of them.
Zero point 0.6944.
So plus 0.7394.
Plus 0.75131.
Zero 0.8384.
0.8384. Plus
Next one is 0.8934.
8934.
The last one is 1.0276.
0.89.
1 point. Oh, okay.
Then here
1.509. Oh, sorry, 1.0276.
then add all these. What I get?
Four 4.9463.
4.9. Okay. So 4.9. 4.9 what?
46.
46. So this is the total for the phase 1. Then we go to the second phase, this one here. This one, calculate it, we use Gordon's model. Okay, which says the value of stock as of the 60th year here is D1 K minus G. So 1.554 over K. Our K is what? K is
8%.
0.08. And our new G is what? 3%, 0.03. What am I getting?
31. 31.08.
As of year 6, that is our value of stock. Then you can discount it, multiply it by 0.630. What are you getting? Multiplying it by? No, you're multiplying by what? Yes, 0.630. What are you getting?
19.58.
Correct. So 19.58. Add these two stocks. What are you getting? That's the value of stock.
$24.52.
24.52. Correct. So that is 24.52. This question was not easy. Okay. 4.52. That's a value of stock. Was in the marking key, there was 24.50. It's the same thing. Okay, because of rounding off the first part and the second part. So find the values of stock for phase 1, which was 4.9. Then you find the value for the second phase, 1.11. Then you add these two after discounting it. Gets 19.60 as of year 6. Then you add these two, you get 24.50. Now let me emphasize that everything has to be hinging on time value of money. So you cannot project this if you don't understand the concept of time value of money. I'll send the solution on the group.